In the heart of the bustling startup culture that defined the 2010s, WeWork emerged as a beacon of innovation, promising to revolutionize the way we think about workspaces. With its vibrant designs, community-focused ethos, and a vision of a world where people could collaborate seamlessly, WeWork quickly became a darling of investors, peaking at a valuation of $47 billion. However, this meteoric rise was matched only by its spectacular fall, a cautionary tale that underscores the complexities of rapid growth, corporate governance, and the volatile nature of market trends. WeWork was founded in 2010 by Adam Neumann and Miguel McKelvey, who envisioned a space that transcended traditional office environments. Their concept was simple yet profound: create co-working spaces that fostered community and collaboration. The early years were marked by exponential growth. By 2014, WeWork had raised its first major funding round, garnering $355 million from investors like Benchmark Capital. This influx of capital allowed the company to expand aggressively, opening locations in major cities around the globe. The brand quickly became synonymous with the gig economy, attracting freelancers, startups, and even established companies looking for flexible workspace solutions. The rise of WeWork was fueled by a perfect storm of factors. The post-2008 financial landscape had shifted, with businesses increasingly seeking flexible leasing options. The millennial workforce, characterized by its desire for community and collaboration, gravitated towards WeWork's vibrant environments. By 2019, WeWork had over 500 locations worldwide and was valued at $47 billion, making it one of the most valuable startups in the world. This valuation was bolstered by the backing of SoftBank, a Japanese conglomerate that invested heavily in the company, believing in Neumann's vision of a global community of workers. However, the very elements that contributed to WeWork's rapid ascent also laid the groundwork for its downfall. Central to this was the leadership style of Adam Neumann, whose charismatic persona and bold vision initially inspired confidence. Yet, as WeWork expanded, concerns began to surface regarding Neumann's management practices and corporate governance. Reports of erratic behavior, conflicts of interest, and an opaque business model raised red flags among investors and analysts. Neumann's penchant for extravagant spending, including private jets and lavish parties, further fueled scrutiny. The turning point came with WeWork's highly anticipated IPO in August 2019. As the company prepared to go public, it released its S-1 filing, revealing significant financial losses and a complex corporate structure that raised eyebrows. The document outlined a business model that relied heavily on long-term leases while subletting spaces to short-term tenants, an inherently risky strategy, especially in a fluctuating market. The filing also highlighted Neumann's controversial practices, including his ownership of several properties that WeWork leased, which posed potential conflicts of interest. Investor confidence began to wane as the IPO drew closer. The company's valuation, once soaring, was reconsidered in light of these revelations. Analysts began to question whether WeWork's business model was sustainable or if it was merely a bubble waiting to burst. In September 2019, the situation escalated dramatically when Neumann was forced to step down as CEO amid mounting pressure from investors. The IPO was ultimately withdrawn, and WeWork's valuation plummeted, leading to a valuation of around $8 billion by late 2019, a staggering decline. The collapse of WeWork serves as a profound lesson in the importance of corporate governance and the need for transparency in business operations. The lack of oversight and accountability within WeWork's leadership structure allowed unchecked ambition to overshadow sound business practices. The company's rapid growth, while impressive, was built on shaky foundations that could not withstand the scrutiny of public markets. Investors learned that a charismatic leader, no matter how visionary, must be held accountable for their actions and decisions. Additionally, WeWork's story highlights the dangers of overvaluation and the speculative nature of startup culture. The tech industry, particularly during the 2010s, was rife with examples of companies being valued based on potential rather than actual performance. WeWork's rise was fueled by investor enthusiasm and a belief in the gig economy, but this optimism ultimately proved misplaced. The stark contrast between its peak valuation and its subsequent downfall underscores the necessity for investors to conduct thorough due diligence and to be wary of hype-driven valuations. Furthermore, WeWork's failure illustrates the risks associated with aggressive expansion strategies. The company's rapid growth led to a sprawling network of locations that became increasingly difficult to manage effectively. As the reality of its financial situation became apparent, WeWork found itself with a significant number of underperforming locations, draining resources and further complicating its recovery efforts. This serves as a reminder that sustainable growth requires a balanced approach, emphasizing not just expansion but also operational efficiency and financial prudence. In the aftermath of the WeWork debacle, the company underwent significant restructuring. SoftBank, its largest investor, stepped in to stabilize the situation, ultimately taking control of the company. New leadership focused on streamlining operations and reducing costs, with a renewed emphasis on profitability rather than growth at any cost. This transformation highlights the potential for recovery, even after a significant fall, when organizations are willing to adapt and learn from their mistakes. The rise and fall of WeWork is a narrative rich with lessons for business leaders, investors, and entrepreneurs alike. It underscores the importance of sound governance, the need for transparency, and the dangers of unchecked ambition. As we navigate an increasingly complex business landscape, the story of WeWork serves as a cautionary tale, a reminder that innovation must be coupled with responsibility, and that the pursuit of growth should never come at the expense of integrity and sustainability. In the ever-evolving world of business, the lessons learned from WeWork will resonate for years to come, shaping the future of how we approach entrepreneurship and investment in the digital age.